Welcome to a podcast about wealth and life. We all know that our finances play a big part in how we live our lives. In this podcast, the advisors from Foster and Motley share insights and information about investment and financial planning topics and how they connect to your life.
You've probably heard the phrase value investing, and you've probably heard the name of one of its biggest proponents, Warren Buffett. But what is value investing, and why does the Oracle of Omaha use it? Well, Mark Motley and Thom Guidi of Foster and Motley are here to offer some insight into the strategy. I'm Patrice Sikora. Mark, let's start with you. Would you give us a definition of value investing?
Yeah, there actually isn't. Well, there isn't a concise definition of value investing. Value investing is a style of investing pertaining particularly to selecting stocks. It's typically in contrast to growth investing, and it typically means that valuation measures, various measures of fundamentals, and they tend to be, it's not exclusive, but revenue, price to cash flow, price to earnings, price to dividends, price to book value. There are a few other permutations, but on some of these measures, the particular stock is cheaper, lower valuation than others. But there's not a universally accepted definition of what value is.
Well, what happens when you see something, you go like, oh, it looks great,
Yeah.
and you jump in. Should you be buying it then?
Yeah, it depends. The answer is depends. It is an important tool that we use to differentiate between companies. It's not the only tool, but in the end, it's an important driver of excess return that as you mentioned, Warren Buffett, he likes to say, and it is accurate, that the most important factor in any investment's long-term return is the initial price, the price relative to, say, earnings. If that is cheap enough and other things are equal, then that will turn into a better long-term investment performance than otherwise.
You mentioned growth investing, growth stocks. Talk about that versus value.
Yeah, that's an even fuzzier definition, because literally by many of the indexes, there's not a positive dimension of growth. It's just whatever is not value. Whatever is not value is actually growth. So they'll take an index, the Russell 1000, and the half of the market cap that is the cheapest is the growth portion, and the rest of it is the half that's cheapest is the value portion, and the rest of it is simply growth. So they don't measure historical or prospective growth prospects. They simply say these are the more expensive stocks, therefore they must be the growth stocks. That's even a fuzzier definition.
Yeah, it's really hard to sell an index called Russell 1000 expensive
or Russell 1000 not value, not cheap.
Can you give me an example?
Sure. There was a lot of talk recently about, a little less so today, but and this definition changed, but the FANGs, the Facebook, Apple, Google, Netflix, and sometimes there's a Microsoft is in there, and Tesla, and whatever. Stocks that are very big, very expensive, many times are 40 and 50 and 60 times earnings. These are recent examples of growth stocks, and many of the banks selling at 10, 11 times earnings or less. And many of the energy stocks, oil companies are cheap. They've been out of favor lately. It's not purely by sector, but there are some concentrations of what are considered value names in certain sectors and growth names in other sectors like tech.
All right. Thom, your turn. Give us a history of value investing.
Yeah, well, when you think about value investing, you're relying on valuing a company, determining what is the right price or the price you'd be willing to pay for a company. If you're not doing that, it's really just speculation. You're speculating that somebody else is going to buy the stock from you, a company from you for more money at a later date. But if you're buying a company to own a company, you really need to know some fundamentals about that company. Mark used the term fundamentals before. So fundamentals really boils down to what's real. What does a company own? What does a company owe to somebody? What debt does it have? What cash does it have on its books? What earnings has it had? Those are all reported in financial statements today for companies, but it wasn't always that way. In fact, the first time that there was an audited financial statement in the United States for a company was back in 1903. It was U.S. Steel produced its first audited financial statement. Obviously, it was probably a very big company at that time, smaller today, but the remnants of it are smaller today. And once you have that story behind a company, you can figure out what would you be willing to pay for that company. Prior to that time, investing was, it's either speculation for mom and pops investors, smaller investors, or it relied on having inside information. The executives of that company knew what was going on. Maybe their friends knew some inside details about what was going on. And we term that insider trading today, but that was just the way things were done prior to that time. So we had the Great Depression in the early 1900s, and 1929, I think, was the kickoff of that. And the regulation coming out of that determined that having audited financial statements are really important. The SEC was formed in 1933, and they required audited financial statements for all publicly traded companies. So for the first time, for all US companies, every investor was able to receive audited financial statements, more reliable information about companies that they never had before.
And these statements were all following the same format, the same rules?
Yeah, there's accounting principles that are required of all financial statements. They've changed over time and evolved over time. But yes, there was kind of a general rules about how things are stated in financial statements. And at the same time, during the 1920s, there was a professor at Columbia named Ben Graham. Ben Graham had some ideas about how to value companies. In 1934, he published a book called Securities Analysis. It was really the foundational work on value investing. And think about at that time, we're right after the Great Depression. A lot of companies have had very depressed stock prices. And some of his first methodologies for how to value companies, one was termed just net. And net is you take your net cash, or the cash that's on the books, minus the liabilities that a company had. And that was the value of the company.
That's pretty black and white.
And if you could invest in a company for less than that, it was considered a good investment. That's not, you can't find that today, but believe it or not, during the Great Depression, you could find companies like that. They trade for less than the cash that they had on their books minus what they owed. So there was some great values to be picked up then. Since that time, valuation methodologies have evolved, including Ben Graham's valuation methodologies. You could look at what is the replacement cost of a company, or even things involving what expected earnings does a company have in future years, and valuing those things.
With all the technology we have today, I can see taking this and just twisting it and ripping it apart and putting it back together so many different ways.
I would say so. So that really got started with computers. We need computers to make all these calculations for us. For those computers to make the calculations for us, it can't be a printed out financial statement. Everything needs to be digitized, where you have a record, a database of all these points from the financial statements. So that work really got started in the 1990s, and professors at that time were just trying to prove out what Ben Graham did. and what other value investors have done since then. And does valuation make sense?
Now, let me jump in here just a second. Ben Graham, Columbia. Who else went to Columbia?
So Ben Graham's famous student, you talked about him earlier, Warren Buffett, in the 1950s, went to Columbia. I think he got an A.
Well, if he didn't, he's earned it since then.
And yes, he was a student of Ben Graham's. Ben Graham was still teaching in the 1950s, and Warren Buffett was one of his students. I'm sure he still cites Ben Graham as foundational to his work at Berkshire Hathaway. And Warren Buffett today obviously could be considered the father of value investing, but that would make Ben Graham the grandfather of value investing.
Did you want to talk about Ken French?
Yeah, I think Mark probably has more familiarity, done lots of study about factors, which were alluded to earlier. So taking pieces from the financial statements and equations based on those and determining if they're explanatory for future earnings for a company. Mark, why don't you go ahead and talk about Ken French and his influence on financial markets and the work that's happened since?
The work that he did, Thom and French, Gene Thom and Ken French in particular, was the academic work that really laid the foundation for factor investing broadly, but value investing more specifically. But his definition is, in one way, that he's for value is one of several, and it's in some ways the easiest to measure, but it's not necessarily the best one. So there are issues with that as well. I'm going to shift gears a little bit, if I may, so to be the politician. We're in the middle of primary season here. The mutual funds, investment managers, ETFs, if they're active, tend to fall into a value or growth camp. I don't actually think of it that way. I think of it as investing versus speculating. Investing means long-term investing as opposed to short-term. The value measures, as I mentioned earlier, are all equating or connecting price to various fundamental measures. And the growth approach is typically one more focused on price and momentum. And it's not to say that there's not some efficacy to momentum over certain time periods. That's one of the identified factors, especially over the approximately 1 year time frame. But there's a lot of volatility in that and lots of turnover. And in the long run, the value measures tend to actually be better. But the issue is that if someone is a long-term investor, they need to think, as Warren Buffett says, like owners of a business. That they're not renting a stock, owning a stock for a short period of time. They are owning a piece of a business. And if that's your mindset, which it ought to be, we think, for long-term investors, then you need to care about the fundamentals. And if you care about the fundamentals, you care about these valuation measures of price to fundamentals. And it's an example that sometimes I use. If you were considering not buying a stock, but buying a small business, say it doesn't require a lot of your time necessarily, or expertise. Say it's a laundromat, sort of reasonably self-contained, and you have two different options, and they're both in similar neighborhoods. They both have similar histories of net earnings, that sort of thing. But one is selling for maybe it's $10,000 of earnings per year, but the price is $100,000 for this laundromat. But in the course of the year, you recently it had experienced about $10,000 net, and the other one about $20,000 net. Well, one's 10 times earnings, and one's 5 times earnings. Now, the one that is more expensive may have some other advantages. It may have newer equipment. It may have reasons for faster growth, et cetera. But other things being equal, if one is just a lot cheaper than the other, then that's the one you would choose. And that's just sort of rational, that it doesn't take academic studies or special experience to have a decision like that. This is just you're buying a given amount of earnings for smaller dollars up front. And that's the basis for value investing. So to me, it's really the basis for fundamental investing and the basis for long-term investing. That said, it's not nearly that easy. It gets from that sort of fundamental starting point, it gets very complex from there, because it's not just a matter of what's the earnings, just buy things that are the cheapest. Many times, the very cheapest companies are the companies that deserve to be the cheapest. And Warren Buffett has a name for that: cigar butts. Pick it off the ground, and it's very cheap. Didn't cost anything, but it's not worth very much either. And so the real challenge becomes sorting out the things that are objectively cheap from, but deserve to be, from the things that are cheap simply because of this sort of psychology, crowd behavior that everyone's got scared and run away from something, but they've taken it too far and then it's gotten overdone. And it tends to be that behavior finance has done a lot of work on this, but it tends to be that the crowd moves too far in both directions, and much of what value investing is about is just fading those things.
It seems to me, though, that if you're going to invest over a long period of time, the risk is going to be different for growth versus value.
Yes, and I'm going to turn that into a question. Does the growth style or the value style involve more risk? And is an investor in stocks wants to minimize risk? And that's a very good question. And the answer, unfortunately, is it depends. The data is not clear on this. It partly depends on the measure. It depends on the time frame. There are some academic theoretical reasons why value investing should be riskier than growth investing. And there's some data to support that. But there are also some behavioral reasons that behavioral finance reasons that some of these most expensive growth stocks have just so little valuation support that when things turn bad for them, as they ultimately do, then there's a whole lot of room to fall. If you break it down into just bear markets, which does better and worse in bear markets, the history is mixed also, and it depends on several things. My own sense is that it depends on the nature of the bear market. So there's some bear markets that are just valuation contractions, like the bear market that began at the end of 1999. In that sort of environment, clearly it's growth that leads the way down. They're very expensive things that lead the way down, and value greatly outperforms in that environment. There are also circumstances where there's a bear market because of inflation or higher rate, increasing interest rates, and the growth stocks tend to be more sensitive to that and tend to fall more. But in many cases, the economic sensitivity of value stocks, the sectors that tend to dominate the value indexes, tends to be higher than for growth stocks. And so if there is a recession expected and a bear market associated, in many of those cases, that's an environment where value stocks actually fall more. So that's a long way of saying it depends.
Yeah, well, we're going into a time now where interest rates are going up. What impact will that have on value versus growth?
Well, we don't know what it will have, but we can say what it has had. It's been a strong period of outperformance of value over growth in recent months. However, if you dial back just a little bit to the spring of 2020, the COVID shutdown, the brief recession that occurred there, growth stocks sort of sailed through that and value stocks took it on the chin. And so that was a situation where the market was really scared about an economic slowdown. Things played out not great for value then. Right now, that's really not the case. In spite of the negative GDP from the last quarter, a lot of the economic measures are pretty strong. Retail sales have been strong, and unemployment's low, and there may be a recession, and the odds have increased. But right now, the market is looking at what's immediate and real, and that's interest rates going up rapidly, and so that's been affecting growth stocks more.
Thom, some thoughts?
Value can at times be more risky. And I think you can mitigate a lot of that risk. Mitigating some of the risk relative to growth stocks or relative to the market. Partly it's a matter of being sector neutral. And I think we spoke about sectors in a past podcast. And sectors are really just all the areas of the economy. And when we were talking about growth stocks specifically, a lot of times we're alluding to technology-oriented companies, one sector of the US economy or of the stock markets. But if you are a value investor, it might be tempting just to ignore technology because their valuations are higher than other sectors. But if you invest in a more sector neutral manner, invest still in technology companies, but buying those technology companies that trade at a reasonable price relative to other technology companies, you can mitigate a lot of the risk from value investing.
All right.
Now, there was studies on, the first studies were on valuation. The Ken French studies, for instance, the academic studies that supported a lot of the modern value investing. But later studies looked at things like momentum, which essentially boils down to those companies that are performing well currently are likely to continue to perform well, or quality, the quality of a company. And if you can blend those factors in with value, you can substantially reduce the risk from a pure value portfolio. So by having a investment selection process that doesn't just lean on buying the cheapest company, but includes quality companies that are performing well recently, and investing in across the US economy, you can have a lot of the benefits from value investing while mitigating a good chunk of the extra risk that sometimes creeps in with a pure value investor. As Mark alluded to before, it's kind of ambiguous whether value is less risky than growth or more risky. But by blending those things, you can certainly give yourself every advantage to be less risky.
If I could add on to that, the two main sort of pitfalls of value investing are company selection, where you gravitate to things that are cheap, and some of those things deserve to be cheap. And the term that we use for that is value traps. It's cheap, but it just keeps getting cheaper. And the other is that the style itself can be out of favor. Growth can do better than value, not just in these bear markets, but sort of just over a number of years for a long time. And that can run for 10 and 15 years. And even though this is an approach that in the long run, every longer period has done better, it's tough to be underperforming for 15 years and think you're doing the right thing. And so as Thom alluded to, there are some ways to blend value with other things like quality and momentum and sector neutrality that tend to mitigate those risks and make that easier ride along the way.
One quick question, and then we'll wrap this up. If we're going through a phase of really long, non-value performing stocks, how do you keep your investors focused?
The challenge is you don't know how long that period is going to be until it's over. And so we came through one of those. We're in the middle of a substantial recovery for value right now that we think is overdue and likely to continue, and all the other sort of stars seem to be aligning to that, but we don't know. But certainly prior to that, it was tough. There were a lot of people that got impatient with approach that they didn't fully understand, and so we just had to double down on the education and explaining why these are better companies to own in the long run than the things that your friends were talking about that are 50, 60 times earnings, but all in the news, and have been doing well and running circles around the cheaper and better long-term prospect value holdings that you hold.
Sounded almost like a Yogi Berra ism there. We don't know when it's going to be over until it's over. But I totally get it.
Yeah.
Totally get it.
It's the way it is. Yeah.
Yes. All right. How can listeners reach you folks at Foster and Motley?
We're on the web at fosterandmotley.com. Spell out the A-N-D.
Is there anything we haven't talked about that you'd like to add?
I think the one thing to add on our website, you can go to the Insights section and see some of our recent writing. We try to write quite a bit, but we also have all the podcasts that we're recording today on the Insights tab on our website. And you can also give us a phone call at 513-561-6640.
Excellent. Gentlemen, thank you so much for this time. And listeners, follow this Foster and Motley podcast about life and wealth for all sorts of investing and planning information. And please share with others. I'm Patrice Sikora, and let's talk again later.
Thank you for listening to Foster and Motley, a podcast about wealth and life. Click the subscribe button below to be notified when new episodes become available. The information discussed and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Foster and Motley. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional financial advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions regarding your financial planning and investments. Foster and Motley is not affiliated with any third-party providers. Any mention of a third-party provider does not imply an endorsement of that provider. If you decide to utilize a third-party provider, you do so at your own risk.